All right. Well, good afternoon. Thank you everyone for joining us. I know it's been a turbulent time in markets over the past few days, so appreciate you taking time out of your day to jump on this call with us. Topic is tariff turbulence, addressing market conditions and policy changes. We have a bunch of slides to run through here today. If you have questions, please send them over to us, and if we have time remaining at the end, we'll address as many as we can. And if we can't address your question, we'll just follow up in an email. I'm Adam Reinert. I'm our Chief Investment Officer. I'm joined by Sean Dan as one of the fellow panelists. He's our Director of Investment Research. And it's been a busy week for the two of us to say the least. So we'll just jump right in it. So I guess to keep compliance happy, here's very important disclosures everyone should read. So we'll pause here for a second. So here's a look at today's agenda. That we have four parts: tariffs and trade deficits explained, Liberation Day and the immediate market reaction, part three, current market conditions, and then we'll end with some forward-looking data. So, Sean, why don't you kick things off here with part one, tariffs and trade deficit explained?
Sure thing. Just to start, just so we're all on the same page, let's just start. What is a tariff? So, a tariff, very simply, is just a tax. Is a tax that is levied when someone buys a good from a foreign country and that good is tariffed. It's just an extra tax that is added basically to that ending price. It makes goods more expensive. And how import tariffs work, we have a flow chart on the right here. We'll put a little story behind it to hopefully go through some very rough mechanics of how they may work in our lives in this new tariffed world. So let's say you really like Italian wine. Up at the top left there, you see those wine bottles. The exporter, an Italian winery, maybe they sell those goods to a PA Fine Wine and Spirits where you go to buy your favorite Italian wines. That wine and spirit store would be the importer. And this is ignoring distributors, middlemen, very simplified example. So when the importer, that PA wine store, buys, say, $10,000 of Italian wine, that Italian winery puts that pallet of wine on a ship or a plane, sends it over to the US, and the importer, that wine and spirit store, receives that $10,000 order. And now, in a world where we have a 20% tariff on European Union goods, that PA wine and spirit store will owe a 20% tariff or tax to the US government. So, very, very importantly, it is the US importer that is paying that 20% or $2,000 tax to the US government. In no way does the Italian winery or any other foreign country pay the US government any money. It is strictly a US consumer or importer paying the US government. Now, ultimately, what does that mean for you when you go to buy your bottle of Italian wine now? Well, that kind of depends. That wine, in effect, is now 20% more expensive for that store to buy. How much of that cost they pass on to you is really up to them. If they wanted to pass on the whole thing, your $20 bottle of wine overnight is now costing you $24. They may stomach some of that and reduce profit margin and not pass the whole cost on to you, but ultimately, what it means is that store is going to see compressed profit margins, and you are likely going to see an increase in the price of your good to some extent. So, key takeaways of kind of the basics of tariffs: the import tax is paid by the importing or US company, it's not paid by the foreign country. Tariffs are generally considered inflationary for the mechanics that we just explained. It is just an extra non-productive tax that is placed on top of a good. And three, tariffs threaten growth as higher priced goods make it so, a consumer, if you're buying a bottle of wine, a $4 increase maybe doesn't hurt that much, but when it's across a broad swath of all goods that we import, it's probably going to hurt your pocketbook to an extent, and maybe you buy less and maybe businesses earn less. So it threatens growth as well. So obviously Trump's tariffs have been in the news. We're going to go over, last Wednesday's Liberation Day announcement, but um, these tariffs that he has levied is a very, very sudden shift away from a trend that we have seen in the U.S. and really across the globe for pretty much the past 100 years. For about 100 years now, we've been moving to a more globalized or free trade environment where we've been reducing barriers to trade between countries and just trying to make it easier for people to have access to more and cheaper goods. We used to be a higher tariffing nation back in the 19th and early 20th century. The thing that kind of put the nail in the coffin as to why we moved away from tariffs was something called the Smoot-Hawley Tariff Act of 1930. So in 1930, in the midst of the Great Depression, in an effort to stimulate American business, the government placed, kind of as we're doing today, huge tariffs on foreign goods to try and make U.S. consumers strictly buy U.S. goods. Unfortunately, an unintended consequence of that is U.S. consumers who were already much poorer because of the recession now had to buy higher price U.S. goods. It kind of created a spiral that many believe worsened the depression. So really since then, you can see some of the trade agreements that we've come to in the past 100 years with our allies to try and reduce those barriers to make trade easier. And you can see on the chart on the left, this is a quick reversal. These are the highest tariffs that we are seeing in this country since, I believe, 1909. Was the last time we saw tariffs above 20%.
Yeah, not all tariffs are bad. Tariffs do have a time and place. For example, if there's a certain industry that we're trying to protect as a country, tariffs make sense then. Also, to try to prevent dumping of certain goods in certain markets, tariffs also have a beneficial effect. Just to reiterate some of Sean's points on the left. We could even go back a little further to the 1890s with the McKinley tariffs that went into effect. Those were largely unpopular at the time. They were implemented by Republicans then. I think in the midterms that subsequently followed, Republicans lost about 93 seats in the House as a result of those tariffs. A similar effect happened with the Smoot-Hawley tariffs. Just Republicans ceded control of the House and the office of the presidency for the next decade and a half, 2 decades, following the implementation of those tariffs as well.
So getting towards why does Trump want these tariffs? Why have we put them in place? The main reason that President Trump has been giving is the United States trade deficit. So we run a trade deficit in the sense that we import many more goods, especially physical goods, than we export. So we are buying more from foreign countries than they are buying from us. You see imports versus exports on the left. And if you move to the right, that's just the difference there. And the lower the number has gotten, it means the more we're importing versus exporting. Over the past few months, we've imported well over $100 billion worth of goods more than we've sold. And Trump, in his mind, he sees this almost as, we believe a business that is selling less than its expenses. He sees it as, that this can't be good that we're paying more to other countries than they're paying to us. But, we generally, and I'd say most economists think this is a little bit of a misunderstanding of the trade deficit and kind of how it, plays in our daily lives. One example that Adam gave as to, a trade deficit that's pretty benign and pretty good in most of our lives. We all as consumers run massive trade deficits with our grocery store. So say, you go to Costco on the weekend, your entire life that you've been interacting with Costco, you've only been buying from Costco. Costco's never bought anything from you. You give them money. In return, they give you goods. Each time you're technically importing those goods from Costco, you are running a huge trade deficit. Now, most people would say that that's a good thing in our lives. We've decided, as a country, we'd rather work jobs instead of trying to grow food in our backyards, and it's more efficient for us to just go to that grocery store. So that's an example of a trade deficit that's not really that bad, and really a sign of a successful, person and successful economy.
Yeah, I'll just add to this. The United States economy is an innovation economy. Um, We are a developed nation. It's common for developed economies to have trade deficits with one another. As part of our growth, growth in itself increases consumption, higher standard of living. We're allowed the opportunity to consume a wider basket of goods. And we've really upskilled the labor market at this point. We're less dependent on labor-intensive industries like manufacturing and can be more specialized, high skill areas.
So that's actually a great segue, Adam, to this slide. Our trade deficit's a bad thing. And I think most economists would agree, we do not think they're a bad thing. You see on the left some of the quotes Trump has had recently about why he doesn't like tariffs. As I said, he sees the fact that we buy more from other countries than they buy from us as these countries ripping us off or taking advantage of us. But we really think it plays into the fact of what Adam just said. We are an economy that is upskilled and moved away from the production of manufactured goods. You see on the top right chart there, US college degree attainment has gone through the roof in the past 50 years. Back in the mid 50s, only about 3 million Americans held at least a 4-year college degree. Today, that number is in the 80 to 85 million mark. And over much of that time period, many of those people have moved on to more service-based, high paying jobs instead of those manufacturing or factory-based jobs. And what that has allowed us to do is earn more money. And instead of manufacturing at home, we've in a sense exported those manufacturing or factory jobs to other countries. And in those other countries, it's also generally cheaper for those factories to operate for lower labor costs and lower production costs. So really, we're making more money as a group, and we are able to buy cheaper goods from foreign countries. And I think the biggest thing we can point to here as to why, some of these countries that he's levied huge tariffs against, proof of how they're not ripping us off. And if anything, unfortunately, it may be the opposite. If you look at GDP per capita, this bottom slide here, our poorest US state is Mississippi. The production in that state per citizen is about $50,000. It's a proxy GDP per capita for roughly, what you'd expect per person earnings in that state to be. The 10 nations in which we put the highest tariffs on are very, very poor nations where people make very, very little money. And in Madagascar here, the average person's making, $500 to $1,000 a year total. And just because we buy many more goods than Madagascar or Vietnam or Lesotho buys from us does not mean that they're ripping us off. It's really more a reflection of we're buying a lot of cheap goods from them. And these countries, based on one, their size, and two, how much their citizens are making in salaries, there's no way they could ever buy as much from us as we buy from them. So I think that's a really good point. Like Adam said, we have upskilled and moved out, these jobs out of the country. It doesn't necessarily mean, that we are being ripped off.
Yeah, just to add to what Sean said, I think if we're also being honest, the upskilling of the labor market, not all consumers and citizens of the country have benefited the same. There is a fairly wide wealth disparity in the country right now. I think that's what makes tariffs and trying to reshore manufacturing very appealing as a Trump policy agenda. I mean, whether we agree with this tariff policy or not, I think everyone can agree that the Trump administration has been fairly transparent on their intentions. It's a key platform that they ran on during the elections last year. Um, whether manufacturing is the right way to go about it or trying to retrain and reskill part of the labor force for jobs that are potentially better suited for our economy in the 21st century remains to be seen. While we send dollars overseas for goods. We do receive some benefit, just not through trade in and of itself. Um, Generally, those dollars find their way back to the United States through our capital markets. So about 20% of our equity markets today are owned by foreign holders. That's about $18 trillion. It's the same thing in our fixed income markets. About 30% of our treasury debt is held by foreign holders. That amounts to about a little more than $7 trillion. And then through our corporate credit markets, it's about 30% of our corporate debt is owned by foreign holders, and that's a little less than $5 trillion today. And that helps us maintain low rates. Obviously, we are the reserve currency of the world. So we do receive benefits, just not through goods trading.
So another reason why we don't think tariffs are necessarily a bad thing, have here our top 10 trading partners, top 10 US companies that do the most importing and products that we struggle to produce ourselves. So, you see here our top 10 trading partners. I'd say most are countries that are our allies, company or countries we try to stay friends with, even our frenemy there at number two with China. But kind of free trade and low barriers keeps us, close to our allies. It's a touch point and it's a reason to remain close with each other, keep strong ties. The second column there are top importing companies. Whether you know it or not, a lot of these companies, yeah, that we shop at each and every week, they import most of their goods. Walmart does the most importing of any U.S. company, and that's the reason why we are able to get so many and such cheap goods from Walmart week to week. Um, and you see it really runs the gamut of Walmart and Target is kind of your groceries and everyday goods, LG and Samsung, your TVs, your tech, and even Dole Foods is kind of your fruit. And then there are also a lot of products that we either can't produce or we don't produce because it's too expensive. On the food and alcohol side, just because of our climate, we can't really grow coffee beans or avocados or bananas at any sort of scale that we would need. And then furniture, technology, and textiles, those are all goods that the cost to employ factory workers or build factories to make those goods would just make them so much more expensive than they are today that it would probably turn a lot of people off to those goods, and companies would struggle to run profitably. And that is why, as we mentioned before, a lot of that manufacturing is done overseas. So, do you want to take this one, Adam?
Yeah, I'll take this one. So we can use the 2018 tariffs as at least to a limited extent as a case study of what we might see this time. The 2018 tariffs were much more limited in scope than we saw rolled out last week. But one of those key initiatives was to target furniture. We thought we could help domestic furniture manufacturers through tariffs. The chart up in the upper left quadrant, that's tariff rates on furniture. So we see when the tariffs go into effect during that late third quarter, early fourth quarter of 2018, the tariff rate spikes up. The goal thinking this would help in production and manufacturing in those sectors. We didn't really see that materialize necessarily. The chart on the upper right is U.S. industrial production of furniture and related products. That index level is generally at a lower level today than it was than prior to the tariffs being initiated. And in the bottom left, the number of people employed in that sector has also decreased over time despite tariffs. So I don't know how we'll have to wait and see how this plays out over a larger swath of sectors. But at least in 2018, it didn't necessarily work the way they had hoped, at least in furniture. So,
Yeah, so moving on to part two here, fast forwarding to the Liberation Day announcements and the immediate market reaction to them. So last Wednesday, April 2nd, after the market closed, the Trump administration announced their what they call Deliberation Day tariffs. Going into the announcement, most of the market was hoping to see 10% across the board tariffs with slightly higher targeted tariffs for specific countries. A lot of people kind of saw that as their base, the bull case. Unfortunately for the market, we got something much different. So you can see here, these are select countries where we do a lot of trading. You can see on the right-hand side the 2024 amount of imports that we bought from them. You see the countries and regions and the tariffs that we have levied against them. The big two here, European Union and China, making up more than $1 trillion of our imports. The European Union at 20% and China 34% was the announced tariff. At this point, with extra levies that we have put on them, the tariff is now sitting at 104%. Beijing responded overnight and placed an 84% tariff on US goods. So that those tensions have only escalated since. But these countries that we have these high tariffs on, it really runs the gamut of a lot of the goods that we buy. You think China, Japan, South Korea, Taiwan, a lot of our tech. Vietnam is where we get most of our textile goods. Think shoes and t-shirts, Switzerland, financial services. So it really covers a lot of goods, and these tariffs end up being much higher than expected. And as you might have guessed, and as I'm sure we've all seen, the market did not respond very well to this. You see the trading here on Wednesday, Thursday, and Friday of last week. On Wednesday, we were flat to slightly positive. I think on hopes that those tariff numbers would come in kind of low, as we were hoping, as maybe we expected. That was not the case. We sold off pretty heavily on Thursday, down almost 5%. Going Thursday into Friday, futures were actually hanging pretty tough. We were only down about 0.5%. But overnight, Thursday into Friday, China announced their first set of retaliatory tariffs, at which point futures sold off pretty hard. And we ended up down about 6% for the day. Now, that 2-day sell-off of more than 10% on the S&P 500 is actually the fifth largest 2-day sell-off that we have seen since 1950. The only three other periods that are in the top 10 are the 1987 crash that we saw on Black Monday, two dates from 2020 and COVID, and the rest are all from the global financial crisis, the Great Recession of 2008.
Yeah, just all extremely volatile periods for the stock market. I think if we were to go look back even further, we would see some dates from the 1930s on here. I think a date or two from 1940 as the war expanded in Europe. So pretty unprecedented, just the scope of decline that we've seen in such a short period of time.
So after Friday's trading, a lot of market participants were hopeful over the weekend, maybe cooler heads prevail. Market participants have time to breathe, and hopefully it gave 2 days for the president and his camp to provide more clarity and certainty around tariffs. Unfortunately, that didn't happen, and we have seen additional whipsawing over the past two trading days. On Monday, we opened up immediately. We were down almost negative 5%. You see that spike higher there. We were then up almost 3.5% on a fake report that tariffs would be paused for 90 days. The White House quickly came out and refuted that report. That is why you see the corresponding drawdown right after that. And we continued to whip throughout the day. Monday was actually the most volatile single trading day that we've had in about 5 years. You have to go back to COVID to see a trading day as volatile. On Tuesday, we actually opened up much higher. There was hopes that yesterday we could announce a deal with South Korea and or Japan on tariffs to lower those tariff barriers. As it became apparent that we weren't going to get that announcement, we kind of grinded lower throughout the day. Another pretty wide trading day, about a 7% range. And another kind of fact that puts us in rare company. That means those 4 straight trading days of about 5% or more of a trading range. The only other period since 1950 are the three we just mentioned, 1987, 2008, and 2020. So a pretty rare and pretty volatile set of trading days for sure. And so I think it's also kind of to get back to the base numbers here and what Trump's goals are and the cure versus the disease in a sense. So if you accepted, which as I've mentioned, Adam and I and most economists don't, if you accepted that a trade deficit was a bad thing, we ran about a $1.1 trillion deficit in 2024. We bought that many more goods from other countries than they bought from us. Just on Thursday and Friday of last week, investors in US stocks lost roughly $6.6 trillion in market cap. Since January 17th through the end of last week, investors have lost more than 11 trillion. So I think that's another thing that's been a little bit of a head scratcher for economists and market participants is, we're so focused on this trade deficit. But if, the shock and awe of the tariffs are going to cause this much turmoil in markets and you're seeing, investment wipeouts of multiples of that deficit, at what point does that maybe become not worth it? And I think the Trump camp response would be this is these are short-term dislocations and maybe you see long run fixing of this issue, but I think it's just important to put the numbers on how big the decline has actually been. So there's an old adage in finance: when America sneezes, the world catches a cold. Something we've talked about on podcasts and our commentaries earlier in the year is international stocks. Even as the U.S. struggled through kind of February, the choppiness began in American markets. International markets had held up pretty strong. That is no longer the case. The deterioration in recent days and really the last week in the U.S., we've seen a corresponding fall really across pretty much all international markets here. We have emerging markets, developed Europe, as well as China and Japan, all down about double digits just in the past week. And last chart I'll leave off with this initial market response, something that is a little bit perplexing and something I think the Trump camp especially is very disappointed about. We've seen a somewhat odd reaction in the interest rate and bond market, something that we didn't really expect. Generally speaking, as market outlook and economic outlooks deteriorate, you would expect interest rates to decline. It's just part of a cooling economy. And so when those Liberation Day announcements were made, we initially saw a sharp drop in interest rates. Up here, we have the 10-year Treasury rate. And this was celebrated by the Trump camp. They said, we're making business easier to do, bringing mortgage rates down, all those sorts of things. And that is what you'd expect to see in a time of market turmoil. But somewhat confusingly, in the past 2 to 3 days, you see a sharp snapback higher in 10-year rates to now we are much higher, have much higher interest rates than we had just before the Liberation Day announcement. There's a lot of debate as to what that may be. Is it just simply stress and confusion in the bond market? That is yet to be seen. But in the short term, unfortunately, those rising rates have hurt bond prices. So we've kind of been hit with a double whammy of lower stock and lower bond prices in the past few days.
Yeah, and I'll touch on this slide a little more in the next section. Current market conditions. So Sean had already touched on this last Thursday, the first day of trading post, or this was Monday actually. On Monday morning, very volatile open for stocks. On Sunday evening on Bloomberg, when futures opened, they brought in their A team to cover the futures open on a Sunday night at 6 p.m., which is pretty rare to see. It just gives you an idea of how volatile things have been. Stocks opened sharply lower on Monday morning. I think at our low, we were down close to 5%. We'd officially entered into bear market territory on the S&P. Shortly thereafter is when that fake rumor began circulating on social media regarding a 90-day tariff pause. And there was about an 8.5% reversal in S&P trading within a very short window of time. Things sold off a little bit after the White House disputed those reports, and then settled in a little during the afternoon as Treasury Secretary Bessent, um, began to issue some comments that they were looking forward to meaningful negotiations in the coming weeks with some trading partners, which had been a bit of a pivot from the messaging that had come out of the White House in the prior week, where there was more hardline stance that these tariffs are going to be in place for some period of time. And that's just going to be the operating environment going forward. So the market was a little relieved then, but I think Monday's trading just shows how starved the market is for good news. If any good news comes about, stocks are ready to recover. This chart shows the path every trading day since when tariffs were implemented. The market reaction begins on the 3rd. Just gap down Friday, a little bit of recovery. Monday morning, we weren't really able to sustain it. I think stocks ended down about a quarter yesterday. Like Sean had said, where there was hope that there'd be some news of either an agreement with Japan or South Korea, one of our trading partners. That news never really came to fruition, and stocks kind of just sold off as the day went along. When Sean and I were talking yesterday, I said that is in itself felt very reminiscent of 2008, where we see large gyrations in stock trading throughout the day just based on what policy might be coming. In 2008, it was, is Congress going to pass relief measures? There would be a rumor, then stocks would advance a lot, then the rumor would turn out to be false, and stocks would sell off intraday. That just had a little bit of the feel yesterday. Right now, markets are just flat out. They lack confidence. VIX, which is the put protection, it tends to spike during times of stress, reaches extremes. That's usually not when you know we've reached some level of capitulation in markets. We're still right around that 50 level today, which is very elevated, as you can see just on the graph. Below is the move in treasury markets. Sean touched on this on that last slide in section two. Haven't really seen any good reason to support, my chart ends yesterday, to support why yields have backed up so much. I've seen a lot of theories, one being that tariffs will cause inflation and the Fed may have to be more restrictive for longer or potentially think about raising rates. There's a theory about forced selling during times of market stress. Traders will sell what they can, maybe not necessarily what they want to. So that selling would push yields up. There's a theory of fiscal stimulus. The Trump administration also has this policy goal of extending tax cuts. So maybe that's part of the reason why we've implemented tariffs when they've gone into effect. They're trying to offset the revenue of extending the tax cuts. But if we do take on more debt, we already have a debt problem as a country. We run a deficit. That could just in and of itself, buyers of treasuries would demand higher rates. So that could be part of the reason. There's a theory out there about hedge funds. There's this hedge fund trade called the basis trade out there, where they arbitrage the difference between cash trading in treasuries and futures market trading in treasuries. And that could be unwound for leverage reasons or foreign sellers. That I'm a little skeptical of that theory of all of them, just because we haven't seen we'd expect to see the dollar move pretty sharply as well. But nonetheless, yields have backed up, probably fairly attractive at this point, I would say. So a bit of an opportunity there in fixed income. We've all not on these graphs. We've also seen oil prices move quite a bit. Oil prices are now below $60 a barrel, about $57 a barrel the last I saw before we jumped on to do this call. Um, One of the Trump administration goals was that mantra, drill, baby, drill. At 50, though, at $57 a barrel, that becomes a lot more to execute. In general, U.S. drilling, they have a break-even cost to start a new well in the United States around $59 to $70 is their break-even cost on oil pricing. So I imagine more oil producers will be looking to shut in production if they can, rather than start to drill new wells at current pricing. So this just compares some of the trading recently around some of those really volatile periods. I would say we're probably at a period of peak uncertainty right now. It's when you can see real wild swings in market pricing. So the left is that real volatile period of 2008. This is when banks started to fail during the financial crisis, and it wasn't uncommon to see really sharp down days followed by really sharp up days just based on rumor. So like I think this October 13th is maybe we're going to pass TARP, Troubled Asset Relief Program. And we would just kind of fluctuate that way until the same thing happened in March 2020. We had some very volatile trading days in there as well. I would say just because there is a sharp up day, that is not necessarily the all clear for volatility. I think volatility is going to be the base case for the near term anyway. In March 2020, March 23rd proved to be the low for that drawdown. That's when the Fed came out with very accommodative policy, flooded the system with dollars to help pull us out of recession. We had some pretty sharp up days following that. Unfortunately, in 2008, while peak uncertainty was in the fall of 2008, markets did not bottom until March 2009. But following that bottom, they rose pretty sharply. I think it was a plus 20% year for the S&P in 2009. So far this year in April, we've had sharp down days to start. Down days haven't been as bad. I see right now the S&P's up, though at any given moment we could be positive on S&P or negative on S&P. But right now, without a doubt, the market wants some type of policy action. That's what the market is looking for. We saw that up during Monday's trade. Just any good news will be very welcomed. And there is some pressure starting to build. In the Senate, there have been a few Senate Republicans that have come out to voice their opposition of current tariff policy. I think even Chuck Grassley joined with a Senate Democrat to push forward joint legislation. The presidency, even donors and on Wall Street and some others, like Ken Griffin, who is a mix of both, CEO of Citadel, has said that this tariff policy is a huge mistake. He is a GOP mega donor. The same with Ken McGowan, the CEO of Home Depot. He said, I just believe Trump's been poorly advised by his advisors about this trade situation. I think he also said he could not figure out the tariff formula itself. Bill Ackman uh, just said, my bad, in terms of the policy. Jamie Dimon, the CEO of JP Morgan, said America first doesn't have to mean America alone. Elon Musk, who seems to be one of President Trump's trusted advisors at this point, got into a very public spat with trade advisor Navarro over the past 2 days. I believe he called rocks. Andrew Hale, who is the senior policy analyst in trade policy at the Heritage Foundation, which is a right-leaning think tank, also does not support the way that tariffs were introduced. And the New Civil Liberties Alliance, which is also a right-leaning nonprofit, they actually put forth a legal challenge to try to limit the international I wrote it down here. I have the acronym. The International Emergency Economic Powers Act that allows the president to put tariffs in place for a national emergency. They were successful. They represented a case that went to the Supreme Court on the Chevron deference that was overturned recently that limited agencies, self-regulatory agencies, on their interpretation of law if there was ambiguity. So kind of noteworthy, I think. Ted Cruz, another Senate Republican, has been a soundbite machine over the past few days. He said if we're in a scenario 30 days from now, 60 days from now, 90 days from now, with massive American tariffs and massive tariffs on American goods in other countries on Earth, that's a terrible outcome. If we go into recession in 26, that would be a political bloodbath that's fairly consistent with what we've seen in history, going back to 1930 and 1890. And then more recently, there are voices in the White House that want high tariffs forever. I hope he listens to the angels. And one of those potential angels would be Treasury Secretary Scott Bessent. He is in the more moderate camp within the administration as it comes to tariffs. He's very respected on Wall Street, seen as a voice of caution. He believes tariffs should be used as a negotiating tool. He flew down to Mar-a-Lago over the weekend, try to encourage the president to refocus messaging regarding tariffs. It seems like he was successful in doing that at this point. On Monday, he was tasked by the White House to lead tariff negotiation talks, which was generally a positive development. It helped them pivot from their hardline stance that these tariffs are going to be in place in perpetuity and that countries had a long time to renegotiate. And he had said if they come to the tables today, he had another quote that is not on here, that we will probably reach some deals with our allies and those countries that have been long-term partners of the United States, both from a military perspective, but though maybe not perfect economic allies, and then hopefully we can approach China together. I think that is a good strategy moving forward. Um, Certainly negotiate with our allies. China probably has less interest in helping us at this point. They don't have to worry about elections like our politicians do, for one. As a percentage of their GDP, trade to the United States is fairly small. I believe it is less than 5% of trade from. So they just don't have a lot of incentive, especially when our markets are so volatile. I think the saying goes, never interrupt your enemy when they're beating themselves. So I think that's probably China's stance to a certain extent. Secondly, today, it's been a pretty heavy news morning. There's some talk that there might have to be a bailout for farmers if China is going to purchase fewer agricultural goods. That's kind of a repeat of what we saw in 2018. So I don't think the administration should have been very surprised that that would happen. Um, so things seem to be developing pretty quickly on the tariff front. Looking forward, there's the bear case is the trade war continues to escalate. That's certainly the worst case scenario. That's playing out a little bit with China right now. The base case being tariffs are negotiated, the situation de-escalates, and then the least likely of the three right now. Though it feels like on any day we can really oscillate between the three scenarios. But I think a tariff negotiation seems to be the outcome that the administration is preparing for at this point. Obviously, an escalation of trade wars tensions would be the worst outcome for the economy and markets and U.S. consumers and public at large. Markets would probably have a pretty big relief rally if there was a pause or elimination of tariff policy. So, with that in mind, unfortunately, the economy continues to move. The economy is dynamic. It's not going to wait for policy. Our trading partners are not going to wait for us to come around and negotiate good deals. They have their own interests as countries that they need to move forward with. Um, so we'll see what happens. But just this year alone, this is survey data from the University of Michigan, consecutive tariffs yet. So it seems that at least consumers were thinking, at least according to the survey data, that tariffs might cause higher on the same page. So, but a pretty sharp rise in expectations for over the next year in inflation. More concerningly, the top households, so the top 33% of households, are also concerned. They are the ones that drive most of the economic spending, at least recently, in the economy. And they are worried about employment. About 72% of respondents in this cohort said they believe that we will have more unemployment during the next year. Obviously, that impacts consumer psychology. If consumers don't feel stable in their jobs, they are less likely to spend. So there are ramifications from that. This is soft data. It's just survey data. It's not hard economic data. So it's not uncommon for consumers sometimes to say one thing and then act another way. We saw that here in 2022 when consumers were generally more pessimistic on the economy but continued to spend. This is actually hard data. This is across all employees, and that has been coming down over the past few years. That's generally not a great indicator for the economy. At least there's not as much pent-up demand in the economy. Employers don't need to be having employees work as long. It typically precedes a recession, is what we've seen historically. But good news is, at this point, consumers continue to spend. Even recently, there was a dip down 2 months ago. Consumer spending recovered. There was a sharp retrenchment in spending during the 2008 financial crisis, again in during COVID. But at this point, this is probably one of those indicators that economists will be looking at on a monthly basis to just get a pulse on what the consumer is actually doing, just not what they are saying. So this is a pretty economic. More good news: the consumers are in good shape, relatively speaking. This chart is the percentage that household debt is relative to disposable income being income after taxes. It was really high during the financial crisis. As people were levered on homes and maybe multiple homes. Credit card spending had generally come down. We're benefited from a low rate environment. Um, if you purchased a home prior to the 20 teens, even maybe during the 20 teens, you had an opportunity to refinance that mortgage at a very low rate during the pandemic. So new purchasers, maybe not as much, but that has helped with debt service payments. So consumer is in a good shape from a balance sheet perspective at this point. On the corporate side of things, this is a similar to consumer confidence. This is CEO confidence, how they view the economy 1 year from now. Generally, that has fallen pretty sharply, pretty recently, just sentiment amongst CEOs. I don't have the chart in this chart pack, though. Planned capital expenditures also not what you would expect to see if we are going to reshore a lot of manufacturing back to the United States. We'd expect to see CapEx spending 1 year from now gravitate higher. It's just kind of remained flat again. We've been seeing declining manufacturing and non-manufacturing orders. Again, this is hard economic data. Generally, anything below 50 is considered a contraction. It doesn't necessarily mean a recession. Again, that happened a couple years ago during 22. But generally, if we see a sharp drawdown and prolonged drawdown in new order spending, that most likely is indicative of a recession. And this is economic uncertainty. It is elevated. No surprise. I think it's at its highest point on record at this point. Trade policy creates uncertainty. I think we can all anticipate or understand why this is so high. Good news is, I think someone had asked a question about profit margins. Profit margins on the S&P are high at this point, near their highest on record. So if there is tariff costs that corporations need to absorb rather than pass off to consumers, they do have some runway to do that. They're in a lot better position than even in the 20 teens or pre-financial crisis when margins were more compressed. Um, Part of this was born by the COVID pandemic, where businesses raised costs very quickly and didn't necessarily lower them as quickly as costs came down. So that padded bottom lines. It's helped support some of the valuation multiples that we've seen on the S&P at this point. So there is some buffer in there for corporations at this point. So it's nice to see consumers in good shape from a balance sheet perspective, businesses in good shape from a profit margin perspective. Just if these tariffs last for a long time, they can both kind of weather the storm. So I think at this point, I think we can take a deep breath with everything. I think it's important to maintain a long-term perspective. We are investors, we are not traders. When we look at 10-year time periods on the S&P, those rolling time periods, 90% of the time they are positive. When we look at 15-year time periods on a rolling basis, monthly basis for the S&P has delivered positive performance 100% of the time. So I think that is important to keep in mind, despite all the volatility that we're seeing today. I think this is a really great chart. Just in US markets, it hasn't been a smooth ride. Their markets have had to deal with wars, various events, crises, and the market and economy have always endured. The quote here on this page is a poem that Warren Buffett put in his newsletter 2017, 2018, that if you can keep your head when everyone around you is losing theirs, you're often better off. But we could probably go through every decade on this chart and pick like one financial crisis and one like general country crisis. They all seem really intense in the moment, but eventually the economy, consumers, and the public adjust, and markets have found a way to go on to higher highs. Thank you to everyone for joining us today. If you do have more questions, feel free to reach out to your planning team. They'll get those over to us, and we'll get answers back to you as quickly as we can. But thank you, everyone.
Thank you.